Welcome, everybody, to a brand new episode of the Speculators Podcast. In this episode, we're talking about trading from the gut and following a process. Trading is this sweet science where there are things that we can put into structure, rules that we can follow, but we also need the ability to make real-time decisions that don't always fit into a box. And trading is this beautiful blend of science and art, and really good trading, it happens somewhere between the chaos and the order. Striking that balance, though, can be very difficult. So in this episode, we're going to hear from some of our past guests about blending the art and the science of trading. I hope you enjoy this episode. Let's begin.
There's a quote that process saves us from the poverty of our intentions. And if you go and really deeply think about what the quote's saying, it's that, sure, process can be hard work and it can be tiring. It can be boring. I get that. Trust me, I'm the first one to say it is boring. But the reality is, what's the alternative? Okay. If you don't have that process, what's the alternative? You have complications, you have volatility, you have, sporadic decision making. So when you look at it, ultimately, the process does save us from our true intentions, which is we would just do nothing and we wouldn't perform, and we would ultimately just become slobs. So yeah, I really like that quote, because it kind of takes the other side of, if you don't have process, you are going to just be suboptimal, really.
Real quickly, a thought, just because I see this a lot and whatnot. Not everything that I'm saying, because let's face, most viewers that would watch this podcast with us here aren't consistent profitable yet, right? They haven't really made it yet. So what I would like to say is that a lot of the very discretionary and very broad tactical ways that I will do this on one day and this on another day and hold all my position today and don't do it the next day, that is horrible advice, if you will, for newer traders, in my opinion. Newer traders, even just developing traders with a lot of experience but not a lot of success, you need to get really, really dialed in with a process. Be very checklist driven. Don't mix and match styles. Get really, really good at doing something in particular. It doesn't have to be just in one market. I don't believe that. It's okay if it is. I think that can be harder. But earn the right in your trading to get more and more and more discretionary.
When you're trading, you definitely mentioned quite a bit of structure, but also some, I think, independent decision making. Would you consider yourself more on the discretionary side of interacting with the market, or more on following the process side?
Yeah, I think anyone who's trading, everyone has a system. Everyone has setups. Okay, so I have a bunch of things that I know. When I see certain things, I know I see trades on almost every bar, right? And I use discretion. Some I take, some I don't take. So I think of myself as a discretionary trader, but all discretionary traders who are profitable have some method to what they're doing. So they look for setups, and they don't necessarily take every setup. And I do see setups on every bar. On a 5-minute chart on the E-mini, there are 81 bars in the day, and on every bar, I see something I can do. I can buy, I can sell, I can use a wide stop, I can scale in. I see something that I can do on every bar. And a lot of times I can see both a way to make money selling and buying at any given moment. And then it comes into management. Do I use a wide stop? Do I scale in? And I don't take 81 trades during the day, but I try to take 5, 10, 15 trades on an average day. And I just plus, you got to eat lunch, you got to go to the bathroom. Sometimes your kids call or your grandkids call. So there are little windows in there where it's just dead time. And when those windows are over, I just go back to work. I just start looking at the chart and try to figure out, what's the chart telling me? What will the next bar and the following bars do? And I'll also take trades that are relatively low probability. For example, a 40% probability is relatively low. But if you go for a reward that is at least twice your risk, that's a profitable strategy. Even if you win 40% of the time, you're going to make money. And if you can make like today, at the end of the day, you can make many times greater than your risk. And, trades like that, even though when you initially take the trade at the top of the day, there was a major trend reversal. I describe it as a higher high major trend reversal or a final flag reversal. And there was a second sell signal bar. If you take that, the risk was not all that small. And I didn't hold for the whole thing, but if you held for the whole thing, I tend to get out and get in, but if you held for the whole thing, you would have made, 20, 30 times your risk. And, that greatly, if you're trying to win 40% of the time and you're trying to get a reward that's twice your risk, occasionally you're going to get a reward that's 5 times your risk or 20 times your risk. And that really helps, your profit, your profitability.
Could you define real world edge, another thing you say a lot?
It's something that I think we have become very sensitive to. I certainly was sensitive to it early on because Twitter and publicly available, you would hear a lot of information about how great somebody's trading results were. And that would go on for a period of time, and perhaps they would post some lovely photos of them doing some things. But the reality is when the markets evolved a little bit, or even maybe they took an outsized loss or something, you'd start to see that unravel really, really quickly. What we view as real world edge is a specific occurrence of events. And in our world, a lot of that is identifying what big players are doing in a specific environment. Maybe it's we'll use an example today. We did a playbook on Krispy Kreme. DNUT was the ticker. And we reviewed the specific day that it was, I think last week, that they signed a partnership deal with McDonald's, right? So all of a sudden, Krispy Kreme went from having, I think it was 327 stores to being sold at every McDonald's location, which is like 140,000 or something like that. 14,000, right, in the US. Like crazy shift in the availability of this product. Well, that's an idea that the stock's going to go up, right? That's not edge in and of itself. But when we broke down the variables of it, okay, this happened pre-market, right? This news came out pre-market. So would an institutional, big players, what we call hedge funds, institutions, asset management companies, would they have time to be able to make a trading decision before the open of whether they were going to buy or sell that stock? Well, not necessarily. So you might be talking about something that's going to move closer to 10 o'clock after those big players have been able to have their meetings, set their strategy, understand how they're going to adjust their portfolios. And then after that 10 o'clock to 10:30 window, that's where you really see the trade starting to set up. So that's where you get it. We take a catalyst and a specific setup, and then we combine it with the trades that are likely to go into, that are likely to provide us with real edge. So if you take the catalyst, which we talked about the positive catalyst there, with the setup, it was gapping up into a resistance area, potentially above the resistance area. It was very unexpected. The quickness of the change showed that in the price action. Then we have a series of actual trades. So the trades are really identifying what are the ways that these institutions could be buying the stock if we're looking to go long it. So we identified a changing fundamentals trend trade. It's really just a wedge breakout that, after 10:30, if we're holding above VWAP, which is something we use a lot of, consolidating, then you see an increase in volume and a break to the upside. That's a trade you're going to be in, and you're going to be in for most of the day. And so we reviewed that trade today. And then we also talked about, I do a lot of scalping. So even if I'm in that trade to hold, that changing fundamentals trend trade, I'm looking for different ways to scalp around in my position. So we had something that I love, which is called the second chance scalp. And I had to build some technology in order to help me find these opportunities. But, you have these different, very distinct scalps that occur within that bigger trade. So it's the combination of all those things that come together to form that real world edge. It's really identifying where are the big players likely to be present, right? Why are they going to act in the way that they're going to act today? And then how do I actually have a superior risk reward and high probability in that moment based on those two previous factors? That all defines real world edge to us. It doesn't mean that it's going to work 100% of the time. We still protect our risk to reward, but it does mean that we're more likely to recognize when those players are present, when they're acting in that specific, predictable way we expect them to act. And even more importantly, when they're not. Because when they're not, that allows us to say, this just isn't right. And you just kind of either don't take the trade, or you're smaller, or you work out of the trade before you take a big rip. So that is what we mean by real world edge.
Would you consider yourself a discretionary trader, or are you more mechanical?
You know, when, and this, maybe I'll make this answer a little bit longer because of what it entails. When I wrote my first book, I had someone from McGraw-Hill sit with me and say, hey, listen, do you trade strategies or do you trade systems? And systems are always non-discretionary. There's no element of, I wonder if I ought to take that. So it tends to be in an automated state. And so I would say I am a discretionary trader, but my trading is very strategy based. So if it's not coming into my support, I won't take it. Well, I'm going to say won't is like mostly a dark gray. It's not black or white, because sometimes I do chase things in a couple of points. But if it doesn't come and the setup isn't sitting where I like it, I'll sit out. Now, a lot of times that leads to FOMO, because I go, Rod, that was fantastic. Why didn't I? And then I end up in that space of losing the bubble of total focus. And, you know, trying to be completely transparent, that's the space that I will move in and out of through the course of a day, because I'm not lasered in, right? I have all kinds of things going around me, my desk, whatever's happening. And so I have a tendency to have only these short pockets of pinpoint laser focus. And then the rest of the time I'm like, oh, a bird. And so I get very much out of sync very quickly and have to bring myself in. So the quick answer to that is I am a discretionary trader, but very strategy based, very, very strategy based.
Yeah. And I think to me, this has to be the dynamic in trading, to where there is a certain science that we can put with our analysis that is very structured and rigid, but trading is more of that art form where it's not black and white, and you have to be able to flow with what's going on and make those decisions in real time and perform at a certain level, which doesn't just involve clicking buttons like it was a program.
Okay, last one here before maybe we move on. I'd be interested on your thoughts on the differences between thinking and flowing when it comes to the actual act of trading. The thinking that we have to do to be able to run things through framework and that slow thought process, but then in the actual skill of trading, that ability to flow with what's happening and not get bogged down with thoughts, thinking and flowing.
Yeah, that's a really good topic, actually. So I think with everything, when you start, you're in that first state, right? You're thinking. I think if you can transfer that at some point, and again, use a style that it transfers that to become more of a flow state, I think that's when it becomes really powerful. And again, I don't like to sort of demean to my students what we do, but you know, we're in and out very quickly with a couple of seconds, and that takes some time to get to that speed and that. But when you do it and you become, and I see the videos from students, you can see they're just in the flow of the market, bam, bam, bam. They're just trading, and I can see from videos when my students send who's in that right state, and there's not really much thought going into it. And that's done for a number of reasons. One of them is mental pictures. So we know that people. If you can see pictures and repeatable pictures, they become very powerful. And the market, so if you can get in tune and you see this and this and this, because we're looking for certain things happening, right, in markets. This and this and this happens on the DOM, we can execute. And so it can become more of what I would call a skill rather than a thought process after a while, for the best traders, definitely. And that becomes powerful, because it's harder to lose that at that point. It's almost like, not going to say like riding a bike, but it's now a skill that becomes more powerful when it becomes into that flow state that you're just, yeah, bam, bam, that's a trade, and you're not even thinking about it. I think that's way more powerful than a type of trading where you're going through this constantly. You have to go through this complex thought process. It doesn't mean there are not checklists with an order method, right? We have certain checklists. Did this happen? Did this happen? Did this happen? But those checklists should be executed. Like I can do it lifetime, just like that. As soon as I traded, as soon as I'm filled on an entry order, I know if it matched, 3 of my 5, 4 of my 5, or 5 of my 5, and I can react, because it becomes instinctive after a while. Bam, 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 yeah, that didn't happen, and you can react. At that point, it becomes really powerful. So I think if you can use a method and transfer it into that flow state, that's really powerful. But it takes time to get there, of course. But that's how, most people that are very proficient at what they do, that's how they get there, right? Is by lots and lots and lots of practice. And it can be complex things, how many hours of practice does it take a Formula One pit crew to do a pit stop in 2.5 seconds? On the face of it, that's a really complex, take 4 wheels off, put 4 wheels on, the jacking up and all the rest of it. But with practice and practice and practice, they don't think about that anymore. There'll be all sorts of things, even the order, maybe they take off mill nuts or whatever it will be, right? It'll be complicated when you break it down into like 50 parts, but it becomes powerful when the guys are not even thinking about it. And the same's for golf swings. I compare often the order method as a style of trading, like a golf swing. You break, I'm trying to tear down people's golf swings and rebuild them completely because I think their swing was taught them wrong. But if you think about that, how many hours of grinding does it take? And when you first have, been going to see a pro and he gives you a new swing or new grip or this or that, it's going to take hours and hours. It just doesn't feel right. The moment after you've grinded it, you're not thinking anymore. Oh yeah, put my wrist here or put my shoulder there. The moment you stop thinking about it, that's when you've nailed it, right? And that's when it becomes more powerful. If you're always thinking about all these things, you'll never swing the golf club properly. You just won't get there. Doesn't mean there's not things you need to continue to improve on. It's always going to be those. But yeah, I like to try to get into a flow state with this style of it, with intraday trading.
Trading from a profiling perspective and even thinking of it as an art, this is leaning more on the side of making discretionary decisions, not just buying and selling because lines cross or something like this. How do you strike that balance of rules in place so that you're not just, all over the place, but having that freedom to trade what you're seeing and to be discretionary?
So I look, it's a lot of different things during the day. In the first time frame, it's generally at targets I have set. So if, like I told you, I put 3 upside destinations, 3 downside. Well, if the market starts going up and value's higher and now my targets are in sight and I take a long, that's what I'm using through a period, because it's strictly the market still forming. I don't know what it really wants to do yet. But as the day evolves and the profile is evolving, I'm going to be looking for different things in the profile that's going to tell me where I want to get involved. If we go trend, certainly going to be selling any kind of, I like to call it the ebb and flow trade. It's like the ocean, right? The tide going in and out. On a day like today, when the market started going down, any push up was worth the short. Now I have a good feel for it. I've been doing it a long time. So some people in my room like, well, I should whatever price I shorted, and I shorted it and it came in 4 points. They're like, how did you know that? I go, I don't know that. I go, it's just the ebb and flow. I'm trying to mitigate my risk. So if B period's low is 30 and now we're going down and now I short 25, I know if we start getting back up to that 30 level and don't have a trend day in single prints, well, then that short might not be the thing to do anymore. But they have to prove it to me, right? I'm a very big guy on odds when it comes to trading. And first they have to prove they want to go trend early in the day. But once they go trend, well, now I'm strictly going to be on that side until they prove that something changed. So as the profile's evolving throughout the day, that's what I'm looking for, like an afternoon rally high. Today was a perfect example of it, and I didn't take it. We rallied, I think it was in G period, and ES just missed filling a set of single prints, and NQ had. And I was waiting for ES to fill theirs to take the short. Well, they never filled them, and that was the high of the afternoon. So I love those type trades, afternoon rally highs, afternoon pullback lows.
Yeah. So when you're sitting in front of the screens, it's more of a matter of maybe to keep that balance of following process and having, you know, some rules in place, obviously, but also being discretionary. Before you make decisions, do you have like almost like a mental model you run things through of, hey, I have an idea for this, but everything's telling me this, so that's a stupid idea. I'm not going to, you know, entertain that. Or is it just a process of, yeah, or I guess what I'm trying to get at is I myself trade very discretionarily. And I think that if you're learning a discretionary type process, especially, which I think it's the only way forward, there's no reality where you get to just follow rules and trade mechanically and do well as a day trader. I just don't believe it. So to make that balance of trading with discretion, but still following a good process, is it something that you have outlined, or is it something that you just intuitively know because you've been doing this for so long?
Well, I think I'm trying to think. It's like a chess game. I'm trying to think 2 to 4 moves ahead. So as the market's moving, I'm looking for what my next move is. So even though I might just be sitting there and not doing anything, and like even on a slow day, you know, my room's like, oh, this is boring. I'm like, well, it might be boring, but what you should be doing right now is saying, if this happens, I want to do this, and if this happens, I want to do that. No matter how boring it is, there's always going to be opportunities without you looking for them. So my strategy throughout the day is trying to think 2 to 4 steps ahead of what the market might do. And that's basically that's my discretionary way of looking for my trades.
I'm just a firm believer in paying very close attention to what I believe are the objective parameters that I'm looking at. So on my strategy cards, for example, like I said to you earlier, if let's say I'm executing a trade, breakout trade, okay, I'll be looking at a chart. I'll be following the price action. I'm not interested in P&L. All I'm looking at is what's the order flow doing, what's the buyers doing, what sort of size offers are they lifting. So I'm trying to observe what are the objective facts that the market's telling me, compare that to my strategy cards that say this is what you should be seeing. And if I'm seeing them, I'm just kind of ticking them off in my head going, cool, I'm seeing that, cool, I'm seeing that. If I see something I don't like, I'm going to go, well, no, I'm seeing that, which, okay, let's keep a closer eye on it. If it starts to, you know, come back and it starts to continue to do that, then yeah, then I exit like everyone else, and I manage to trade accordingly. But no, I'm not someone that clicks and walks away. I'm someone that when I'm in the market and I've got risk on the table, I'm watching it. Okay, sure, like I said to you earlier, I've got a DAX trade on, and that is very much a put your stop in and, you know, leave it. But no, I'm a firm believer in, you know, for example, if DAX closes today where I want it to close, that's an objective fact I'll observe. I'll tick it off first thing tomorrow morning, and I'm happy to stay in the trade until it stops showing me what I want to see.
Would you say you're trade on discretion, or do you trade strictly mechanically?
I'm pretty mechanically. I am. I'm more focused on, this is what I'm looking for. This is what I need to see. These are my rules. Is it in the rules? Yes or no? If it is, here's the type of trade I'm taking. And then from there's some discretion. I love the quote, learn your rules like an engineer and know when to break them like an artist.
Yeah.
So,
wow, that's really nice. I like that a lot too. Thanks for saying that. With your background in engineering and maybe even one of your strengths that you're bringing to the table here is being able to think in systems. And I think for traders specifically, there's just a few major disconnects between what we're doing here and what our tasks are and what our responsibilities are, and way too much emphasis on, you know, following indicators, or way too much emphasis on just the input maybe of what would go into the trading system. Could you just talk a little bit about systems thinking, maybe what that means to you, and through that process of engineering, how you've used that in the markets?
Sure. One of the first courses you take as a chemical engineer would be process engineering, it turns out. And the simple example I'll give you day one as you come into class is the tank of water. You got certain flow of water coming in and a certain flow of water going out. How long is it going to take for the tank to fill or empty or whatever? And they give you all the math and trying to understand how you calculate the volume of the tank and everything. So when I get to trading, to draw the analogy, isn't trading a lot like chemical engineering in that, or process engineering in that, in a chemical engineering situation, you're bringing in raw chemicals of feedstocks and various things, you're processing them into something else, and then you're shipping them out by rail car, tank car, pipeline, whatever. In trading, you're bringing in data on prices. You're processing a decision-making process that involves taking prices, making sense of them, deciding whether you want to buy or sell, what are those orders going to be, how big are your positions going to be to make them all be appropriately sized for your portfolio and your risk tolerance and everything. And then you create this consolidated set of orders and you have to ship them out to the brokers. That's kind of, isn't it kind of like a chemical factory, except with information? So my whole life, all I did was to just constantly look at that process and say, okay, how can we make the data better? How can we make our processing of the indicators and the trading, the orders, the prices we're going to buy and sell? How can we make that faster, less error prone? How do we consolidate orders when you have multiple strategies? You might be going long one and short the other. You need to offset those so you don't do two orders wastefully. You just do the net of all of those orders. And the other thing that serves to do is for those guys on the other side that are receiving your orders, they can't really figure out what the heck you're doing because you got multiple strategies being combined together with the orders. It's really hard for anybody to copy what you're doing. They'd have no idea what they were looking at. So you get all that done and you try to make it more efficient, less error prone, more logical. You try to fill the potholes using new indicators, new markets, new time periods, and you just keep combining and making it better and better over a lifetime.
I really think that there's a few maybe like foundational thoughts that if people could apply it to their trading with, you know, thinking about it more like a business, thinking about it in systems, and I think it would cut down on so many of the reckless decisions and some of the reckless moves that are just easy to do if you're not running through these thoughts, but you're, you know, just kind of, you know, God forbid, falling into the trap of just chasing around price. And maybe even a very simple way to think about, let's say as an active trader, especially the water tank in a situation being your P&L and how much capital you have, and the trade decisions you make potentially being that input, your trading losses that you take be the output. And something that was very important for me is I actually read a book called Thinking in Systems. And that idea to me, and the first time I really realized that, wow, the trading is not just about chasing P&L coming in, but if you can do something to limit the P&L going out, you're basically doing the same thing for, you know, let's say growing or preserving that capital tank. And if somebody was maybe thinking as well as like, you know what, I don't really have a lot of structure in my trading, maybe the idea of becoming more of a systems thinker would help me and benefit. Is there something you would recommend somebody, if they wanted to actually take the initiative to learn more about thinking in systems, what they should do?
Well, I think that the new book I just wrote seems to be getting rave reviews, and it's really talking about lots of different systems and how to integrate them all together into sort of an all-weather approach. So that would be a very inexpensive way, since it's just the cost of one book. The other thing that I recommend a lot of people think of is to treat the next trade as the next piece of data in a database of your next 1,000 trades. Now, when you think of it that way, all of a sudden you've really, really de-emphasized that single trade. And it allows you to step back and see that you're trying to get to 1,000. So you've got to do a lot of these trades. This is just one more. Just keep going and keep looking for the next one and the next one and the next one. And it sort of gets you in that systems mentality of building a database of 1,000 trades so that you can really analyze whether your strategy is doing anything or not, because one trade does not make a strategy successful or a failure.
Let's say there's a scale of completely mechanical and then trading 100% off of gut. On a scale from like 1 to 10, 10 being no real process, just sheer what you see and think. How discretionary would you rate your style of trading?
Very high, I think, in the other direction. I don't just go off gut. I have to have a number of data points that's, all these different data points come together to support that. They create the thesis, not even support it. They create the thesis of what the idea is. And then I go with that. What I will say, though, is that as that process is unfolding, that whole gut thing that you're talking about, experience improves that. So if somebody is just new to it and they're just trading off that gut, just kind of very off the cuff, you can see that as a recipe for failure a mile away. But if you have somebody who's been in the game for 10, 20 years and they've got some consistency under their belt or whatever, and that person tells you like, okay, this is just not feeling right or whatever, that should be listened to, because that person is getting that gut reaction, not from their personality or not from a lack of discipline or something like that. They're getting that gut reaction because they've seen this movie before, many times. They know price action so well. They know how charts work. They know what things should be doing if it's going to continue to work out in your favor. I'm a huge believer of that. That's the type of thing I'll do all the time, especially in the daytime frame, right? I think that what we're talking about has a lot more application in day trading than it does in longer term trading, because in day trading, things can really turn against you like on a dime, and large profits can go to zero or become losses almost instantaneously, because obviously the amount of movement that we're trying to exploit is smaller. So we need to be right and stay right for that short amount of time and get ourselves out of the profit before we're no longer right. So it has much greater ramifications for that. But definitely once you've been in the seat for a long period of time, you definitely start to develop that gut a lot in terms of, in terms of daytime frame price action. A lot of it really comes down to what I call the hashtag WWSHD concept. This is something that I came up with, which stands for when what happens doesn't. WWSHD, right? Excuse me, I apologize. When what should happen doesn't. Apologize. When what should happen doesn't. This is a 5-letter thing that I came up with. And that really, I think, should govern a lot of people's trades. They should constantly keep asking themselves, what is the market doing? What is the market trying to do? How good of a job is the market doing effectuating that thing? And if it's not, it's time to go. It's basically time to go. That's super duper important. I'm actually glad you asked that, because if we could distill all of this discussion down to one thing, really, I think it's the most important thing for traders to know the when what should happen doesn't concept. Because when something happens that you think shouldn't be happening, it is 99.9% of the time going to cause a pretty large rip in the other direction, whatever that may be, up or down. That is what's going to cause that. And it's natural, right? Because nobody sees it. They're all thinking the opposite thing, and they don't catch it fast enough to know when that opposite thing, when that thing is not working anymore, and they're all piled into that one side. We see that very clearly in the market. That's obvious. You see that mostly at the low of the day, high of the day, like in the S&P or NDX, where classic example would be like a trending morning that usually will go down from 9:30 to 11:30. So you have 2 straight hours of decline, and then you have the flattening out where the decline starts to consolidate. And it usually happens in one out of 2 or 3 ways. Either there's a strong bounce there, which is shortable. That's the easiest way, because that bounce is going to go either to the VWAP or it's going to go to some sort of declining moving average. There's a lot of different ways to look at it, and you short that. That's easy. That's the easiest one. The hardest one that people get screwed up on all the time is the trending down decline that goes down for those couple hours, but then spends the next 3 hours sideways and doesn't break in either direction. And not usually, but think about it. What's happening at that point, if prices are staying low at the low of the day, the majority of the players are net short. They have to be. They have to be net short. We know this for a fact, because if they weren't net short, they would not have been able to bring the market so low from the open, and they would not have been able to keep the market low over the entire midday period. And that right there, if you're short, is you must be watching carefully, and it's dangerous. You have to be careful. And that is very often a recipe, right, for the market to go up hard in the other direction, because it's when what should happen doesn't. Because what should happen, what normally people think common sense wise, is that bear flag is going to break lower in the afternoon. And very often it doesn't. And what happens is you go hard in the other direction. So from a day time frame perspective, if you're in that time frame, that's a perfect example of something that you have to be extremely vigilant for.